SanDisk stock is up 551% since January, capping off a massive 4,000% rally over the last 12 months. That growth comes directly from a successful pivot. They are manufacturing the high-capacity memory hardware required to run modern artificial intelligence and data centers, and the financials back up the hype. In their latest quarter, they reported a 97% sequential jump in revenue, all while carrying zero debt on their balance sheet. Their future pipeline is highly secure. They have locked in $42 billion in long-term supply contracts, and every memory chip they can manufacture in 2026 is already sold. Wall Street analysts recently upgraded their revenue estimates for the company by 212%. But looking past those upgrades, the actual mechanics of the market are flashing a severe warning sign. SanDisk's operational dominance has outpaced its stock's realistic value, creating a setup where a great company becomes a dangerous investment. Look at this dial showing the Relative Strength Index, or RSI, a gauge measuring the speed of price movements. When bought too fast, the needle crosses 70 into overbought. SanDisk's RSI just hit 80, crossing that extreme threshold twice in a single week. To understand why that matters, we also have to look at the 100-day moving average. This is the average price over the last 100 days, acting as a historical anchor for a company's realistic market value. This chart compares the two metrics directly. The thick anchor line represents SanDisk's historical average of $705. The erratic, elevated line shows where the stock is trading right now, at $1,562. When a gap this wide forms, market gravity takes over. Stocks rarely sustain this altitude forever, and when they snap back to their historical average, the downward correction happens fast. The stock price has completely detached from the company's daily operations. It is surviving on speculative momentum, and that math is unsustainable. Stepping onto the factory floor, we see why this momentum is temporary. SanDisk's massive profit margins are the direct result of a physical chip shortage. This cycle chart shows how the boom and bust memory chip industry works. A shortage leads to a price spike, encouraging overproduction, which causes a price crash. Because prices are high today, manufacturers are boosting production. When that new supply hits, the shortage ends abruptly. Investors who track these patterns, like Michael Burry, see behaviors in the semiconductor space perfectly mirroring the dot-com era's peak. SanDisk has $42 billion in long-term contracts for a safety net, but they cannot completely insulate them when the market floods and spot prices drop. The current $1,550 price tag assumes this market condition lasts indefinitely. It leaves zero room for error when the inevitable wave of new supply arrives. For investors who bought shares well before the pivot into AI, this rally is a massive, justifiable victory. But injecting entirely new capital at the absolute top of the pricing cycle introduces a severe asymmetrical risk. Entering a position at an RSI of 80 abandons the logic of investing in AI growth. Instead, the trade relies on the hope that SanDisk can permanently break the established laws of the semiconductor supply cycle. Sometimes a perfectly executed business strategy actually creates the single most dangerous trade on the entire stock market.